There
we go. We're live.
Yep.
We're live. Okay, so let's start. Hey everyone, welcome to our first live FinTech Summit. For those of you who are new and don't know Icon, I urge you to go on our website, iconsv.org, and learn about everything we do. We have a lot of online content now during COVID-19, and you're welcome to join us. First, I want to actually thank Rachel, our COO, who's the driving force behind this event, made it all happen, like she does all the time, making everything happen. So thank you, Rachel. And I'm happy to introduce our speakers today. Our keynote, Miki Malka, an entrepreneur by design and investor at heart, focused on the utilization of technology to disrupt consumer financial services. Miki is the managing director of Rebit Capital. Interviewing him is the famous Ifat Oron, CEO of Leumi Tech, coming all the way, well, for Ifat, for you, it's nighttime in Israel now. And Ifat and Leumi Tech has been partners of Icon and believing in us from day one, so thank you. After the panel, after the keynote, we're going to have the rest of the panel join us. We're going to have Adam Nash, who's Icon co-chair, but also a CEO, product leader, investor at various companies in the fintech space. We're going to have Audrey Kim, head of product at Square Capital. Eyal Lifshitz, founder at Bluevine, an Israeli startup. Well, Eyal Lifshitz is Israeli. Bluevine is a startup in the fintech space, and will be moderated by Eden Amirav, CEO and co-founder of Become, who's also an SB 101, which is one of our programs alum. So without further ado, I'm going to go off screen and give this stage to Ifat and to Miki. Welcome, everyone.
Thank you very much. Thank you. Hi, Miki. Yasmin was kind enough to give a little brief introduction about you, and if I go on everything you've done, we're going to be left with no money to ask you no money.
Yeah, let's talk about everything. Let's talk about everything that we still have to do, not what we've done.
Yeah. So very happy to be interviewing you. We'll jump right in, and I'm telling the audience we're going to do 15 minutes of discussion, and for the quick ones that are going to have exciting questions, we're going to allow you to ask maybe one or two questions before we move to the next section. So Miki, you have a very rich background, and you have been very active in founding, leading, selling successfully, and also investing in B2C companies, specifically fintech, brand names. One of the things that we in Israel are struggling with is, should we go for B2C type companies, or should we do B2B, just for the mere fact that, sometimes we're far away from the markets, etc. What do you believe in and why?
So in my experience with Israeli entrepreneurs is that they are better designed for B2B than they are to B2C, particularly for the same reasons you just said, Yifat. They're far from the market. Regulatory hurdles on every market are very different. You have to be a little bit more local. You can always start remote, but if you're becoming successful in a market with financial services, you need to be locally regulated. It's a fact of life. So it's really hard for a lot of those components to really succeed when you are working out of Israel. It's not impossible. We've had a few success stories in our, Bluevine. Eyal is an example, and there's a few more even in our own portfolio. Next Insurance, Guy Goldstein has his team in Israel, but they're also local here. So I think it's a mix that it needs to happen. I think Israeli entrepreneurs are really strong on B2B. They've been really learned the core infrastructure of what runs behind everything that we see, and that has made them a really strong kind of entrepreneur to build those kinds of companies so far.
Do you have the proportions of how your portfolio looks like, regardless of Israelis or not?
In terms of B2B and B2C?
Yeah.
So it has shifted over time. So we've definitely, a lot depends on what you call B2B versus B2C. Is Stripe a B2B or B2C? It's actually more of a B2B but it's a consumer brand. It's a brand that the people know about in a much more clear way, or Gusto. I would say that today, probably 20% of the names in our portfolio are B2B, maybe 35% of all the dollars that we've invested are B2B. whereas the majority still has been historically still building consumer or small business financial brands.
Wonderful. Okay, let's move towards a little bit of diving into how COVID is influencing fintech. And honestly, and my opinion is that, it's too early to tell. That's my personal opinion. I think that, things may shift, and, things that we're seeing in the markets are a little less clear than what we would have thought about entering a crisis or a pandemic just such as this one. But how do you feel about different sectors in terms of which ones are actually benefiting from the situation, and which ones do you think are suffering short term and will get out of it successfully, and which ones you think may be, may be suffering dramatically from the crisis?
Sure. So I have a different opinions than what you just shared. So to me, COVID is simply accelerating the value of anything that is a bit compared to anything that is an atom. And it's just making it go faster. The digital realm is just taking more of our mindset, more of our time. I mean, there are 6 weeks ago, you had the president of the Central Bank of India and the Reserve Bank of India on national TV incentivizing people to pay with QR codes and don't use bills because bills can transmit viruses, the paper. So it just tells you that you could see a trend of accelerating of financial services. So I think if fintech was in an up trajectory, I think it's going to accelerate. Now that doesn't mean that it's everything accelerates. It doesn't mean that it's all going to go up to the sky and there's no even the bad companies are going to make it. No, I just think that great companies will probably grow much faster than they were ever expected, and we're starting to see that within this COVID. So I think there's a macro trend going in that direction. I think banks are going to have been waking up in the last few weeks and realizing that they've been running a business for 3 months with no branches or limited branches. And they will have to probably revisit, do I need so many branches? Do I need so many people? So as long the banks are going to be spending a lot of their time in the next year or two hiring the McKinseys and the BCGs and the consultants on how to close down branches or how to move more out of that, while the fintechs don't have the legacy and will be able to keep growing. So I'm very optimistic about it. Now, not every vertical will behave the same. In this, we're on if we talk on China terms, we're probably on week 30, week 25, 26 of COVID. If we talked in Western world, we're probably on week 16. We're 10 weeks behind China in many ways. In 16 weeks, what we've seen clearly is that there's certain trends that are going just much faster. Online payments, anything that is processing, all of us have been buying more online. So every time we buy online, somebody's processing that payment. That's why you're seeing momentum in that vertical. Online wealth management. People are definitely spending more time managing their own money through digital channels. Everything, no matter where you are in the world, in our portfolio, anything that has touched wealth management has been growing. The same with certain insurance products like auto insurance or health insurance. Those are growing much more rapidly, and people are getting more used to telemedicine. So you're more willing to take an insurance policy online. So those are trends that are going that direction. What's been really getting slower or having a tougher time are more the lending companies. And it's not because of their model compared to traditional lending. It is much more that it is really hard to lend these days. You don't know if somebody's employed, unemployed, if the company will be around, if the business will be around, how much money will they have, when will they open. So there's a lot of unknowns to become a lender in any vertical right now. So you have to be extremely careful about lending capital in an environment like this.
In terms of Ribbit Capital, what would be 2 or 3 main themes that if somebody comes up to you, you'll definitely take a meeting?
So we take a lot of meetings, but we don't take enough meetings. We say no to a lot of things early. So in the last 90 days, I'll tell you what we've done because that's a great proxy to what we're seeing. We hadn't been doing very early stage for almost 4 years. We've done three very early stage companies like Series C or A, one in China, one in Brazil, one in the US. And then we have doubled down in two of our best companies over the last 90 days. And what I think we would love to see now is more people working on wealth management. We think it's a massive vertical that is just being touched. And I'm glad we have people like Adam, who was one of the founders at Wealthfront, and he will tell us. I'm curious to see what he has to say on this. We're really looking to find more companies working on facilitating small business services online. It's clear that no store, no business owner can now survive just on the physical world. They need to have a hybrid between physical and online. Anything. If you're a restaurant, it will be online ordering and offline ordering too. If you're any kind of store, you need to sell online and sell offline. So that hybrid of offering all those services is going to become really critical for us. And we're very keen to look at more on those categories. And then I would say certain verticals on insurance, where we think that insurance is fastly accelerating online. Not everybody is designed to become an insurance company or an insurance carrier, but if you're one of those entrepreneurs, we're very interested in talking to you.
Great. One last question. How do you, as a fintech investor, look at the Googles and Amazon and all the big players? Are they intimidating you? Are you worried they're going to take over a few of the sectors that you're invested in, or you feel there's room for everybody?
So we have this analogy in Revit. We love analogies, and we're very big fans of Star Wars in our team. So we've used Star Wars as a way to symbolize this. We always said that the banks are the empire. We always say that the fintechs are the rebels, the little companies trying to beat the empire. And now we've called the big tech companies, they are the republic. They are that incumbent that has the power to do a lot and can influence a lot. I think that it's very different what's happening around the world with them. Like in China, they're definitely extremely savvy about this, and they are aggressively investing into a lot of companies to really control the category of financial services. So they will have their legs into banks and payment companies and insurance companies, and they are doing a lot of that legwork. I will say that in the US, the big techs that are dominating the Western world are not there yet. They're heading that direction. They're slowly thinking about it. They're playing. Apple is playing with Goldman Sachs on the Apple Car, but that's more of a hybrid. Facebook is trying on their own with launching Libra as an association, and WhatsApp payments is an experiment which is still very early and is showing that it has some regulatory hurdles because of the Facebook mantra around it. Google is toying with Google Pay in India. It's the biggest payments company in the world is Google Pay in India, after whatever Tencent has done in Alibaba in China. So they are successful when they put their heads together, but they need financial services partners. They cannot do it by themselves, and they will not become banks themselves.
So maybe ended up as we're the empire, so we need to strike back. I think that one of the interesting things, I'll just end up with a little note on the banking side. I'm representing Legacy today. In terms of, all these entrepreneurs who are actually doing B2B, I can tell you that just like you, Mickey, said, we've moved, I think, 5 or even 10 years, fast forward because of, or thanks to COVID-19. We moved from working in branches to working from home completely in a pace that if you ask us 6 months ago, even McKinsey's won't imagine that we would be able to do something like this. And I think that this trend is something that the banks are going to continue to push forward and are going to need to use a lot of technologies and a lot of interactions with the fintechs and do a lot of collaborations to take it even further. So I think there's a huge opportunity for, working between the banks and the fintechs to a place where in my opinion, we're very, in a few years, we're not going to be that different. Banks are going to be more technology-like, and fintechs are going to be more banking-like, because they're going to have compliance and all the ugly things about finance. Thank you very much. I'm trying to see if anybody's asking us questions, so I'm looking here. No, I see hi, and I see Rachel or Yasmin. Do you know if there's anything on the Facebook?
And no, we don't have any questions for now. Thank you. I'm going to add the other panelists. Thank you so much. Stay with us, okay? We still need you. Just a second. Hi.
Hello.
Hello.
Hi there.
Hi, guys. Can we start?
Yeah, we can hear you.
Yeah, I think so.
Great. Okay, guys. So great to have all of you on the panel. Some of you I know, like Eyal from Bluevine, and some great to meet you. I think it's very interesting to have all of the fintech guys on the same panel, and we prepared some very interesting questions, I think. So we'll go ahead and start. I think 2008 recession, we saw the founding of Square and Wealthfront, among other big names. So I think we'll start with Adam and Jackie. Maybe you can share with us what startups can learn from these two fintech success stories, especially after we see such a aftermath of fintech crisis in this Corona event.
Well, it's always fun to tell a story after Mickey has a chance to frame things, because I agree with him completely about the situation now in the COVID crisis and the acceleration that's going on. It's hard to remember now, but 12 years ago, 2008, the financial crisis really was a fundamentally, I think, game-changing moment for fintech, because we were just entering the point where we were internalizing the lessons of Web 2.0 and how to actually make products that emotionally engage with their users. And as you know, money is fundamentally about trust. And in some ways, a lot of what was missing in the early days around fintech applications was the ability to actually earn the trust of a consumer, of a business. The second thing, of course, in 2008 was the brand damage to the incumbents in a crisis is always tremendous. And I think that's consistent across crises. In crises, most people start questioning their assumptions about who's in control, who has their back, who can support them. And as I remember, even in 2012, the top 10, or I should say the bottom 10 damaged brands from large Fortune 500 companies were large US financial institutions, right? The brands that companies had spent 100 years building were not more valuable than the new brand that was coming out from a startup, whether that startup was in Asia, in Europe, in Latin America, or in the US. And so I think it was a phenomenal time. You combine that with demographics, with always waves of new young people entering the workforce. And it really was a perfect combination, in my view, for getting the fintech revolution going in terms of getting these companies going.
Adam, just a question, and then we'll move to Audrey. Do you think today, is it more similar or different than what we saw back then?
I think it's similar in some ways, but it's a different characteristic. 2008 was a financial crisis, so it's particularly damaging to the large financial institutions and brands because they were seen as, at best, unable to prevent it, and at worst, the cause of the crisis. And so that's hard to match that. I would say the difference is in this crisis is that it's much broader in terms of demographic, right? We could argue that young people were very worried about traditional institutions after the financial crisis, particularly the polling for millennials and Gen X were bad. In 2020, my parents are in their 70s, and they're not going to bank branches anymore. They're learning how to use Zoom. They're doing work and business online. And so I think this crisis, the acceleration it's putting on people to consider digital solutions as not just equivalent to physical solutions, but in some ways more needed and better and healthier than the alternative, is really a game changer in my book for a broad swath of the population that FinTech 1.0 wasn't really able to hit.
Okay, thank you. Audrey?
Yeah, hi, I'm Audrey. I'm representing Jackie Reeses from Square Capital. But I would say two things in terms of building companies after a crisis. One is, generally speaking, I think it's hugely to the advantage of startups to start in a crisis, because what crises do is they unfairly advantage those who can change really quickly. So I think that's great. You can respond to the emergence of new problems that people didn't think were a big deal before. So I think that's very good for startups generally. I would say for fintech specifically, the other thing that crises do is they really exacerbate problems of access. So Square just participated in the PPP program, for instance, and you could not ask for a more stark example of when big banks have to choose which customers they're going to serve because they had a limited set of resources in terms of the number of people who could literally physically review a PPP application, which is why you have all these stories of banks, of businesses who loyally banked with Chase and Wells Fargo for 10 years, and they never got a response on their application at a time of like incredibly dire need. And so the fact that they could turn to fintechs at that time and just get access that they couldn't get from the big banks, I think was hugely helpful. And so, in general with fintech, I think money, especially with lending, is a little bit of a commodity. Like the dollar that I get from company Y, I can spend in the same way that the dollar I get from company X. But I think access is often how companies can actually differentiate themselves. So if I were you, I'd focus on that.
Okay, yeah, and I think it's pretty clear that we still don't know yet the full implementation of this crisis. We still don't know the full impact it will have. Mickey and Ifat, you covered before in your talk which industries or which trends in the fintech world are showing good signs that you want to invest in them. Are there certain areas that you would consider now not to invest in? We have a lot of startups that maybe should know that.
So I think there's no areas that you would not like to invest. I think it's always open for opportunities. The one thing that Audrey was saying, and Adam too, which I think is important to reinforce to these entrepreneurs who are in the call now, is when you look back at Square in 2009, Wealthfront, when you look back at Stripe, started in 2009, Adyen started in 2009, Credit Karma started in 2008. It takes a decade plus to build a sustainable financial services company, because the only way to get there is by finding a hook, then two hooks, then getting regulated, then scaling, then finding the way to do a third hook. So whoever thinks that this is going to get solved in 5 years or 2 years or as a quick turnaround of an opportunity, I mean, I've met Eyal when he was starting his seed round, and that was 2014, Eyal?
13.
13. So it's already 7 years. It just takes a long time. And whatever you're going to do, any sector is not out of the norm, because by the time you be successful, it will take probably 5 to 7 years, because that's how this sector works. You can fast track it and get some momentum, but it's not a given that you can sustain it.
Thank you. Ifat?
Maybe, yeah, I'll jump in. So I think I touched on it a little bit, but Audrey focused it very, very nicely. So everything that will make banks become more like you guys, the techies and the fintechs, we're going to invest in. We're not investing, we're collaborating, but anything that will allow us to recover costs, because our businesses are suffering as well. The interest rates that are going down are not helping banks either. So we're going to need to be more efficient and quicker. So anything that has to do with onboarding, how do you utilize data, how do you do a lot of zero-touch interaction with your client, is everything that we're going to focus on and are going to push much harder than we pushed probably in January of this year.
Thank you. Eyal, moving to you. Underwriting, when building underwriting models, one of the most important things is to have a consistency and to know what to expect. Now, COVID has really changed this. How do you build a new underwriting model in a world where certainty just doesn't exist anymore?
So I don't know if to know what to expect is the right way to talk about lenders. I wish I would know what to expect. But you're right in the sense that credit models and underwriting are based on a specific macro environment. Typically, they don't adapt well to major shock to the system, and they're not meant to. A lender that is proven to be a good lender is not about whether their models hold during a big shock to the system. It is really around how quickly they react and how quickly they evolve underwriting to meet the new environment. I think you also rightfully pointed out that we're still in uncertain times. So the issue is there's still no clear what normal is, and it's hard to build underwriting models where there's still a lot of variability and volatility. I mean, we're seeing it in the public markets. People are concerned around a second wave. So it's still, it's not clear what the new normal is. I'll start by saying we are getting back to lending. I mean, we've been very busy with PPP lending in the last quarter. It's not, you can't lend at the rates that we're lending when money is given away for free. So it wasn't like we had an opportunity to lend anyway. But we are getting back in July. We'll start lending again to new clients. And the way that we're approaching it is we're applying more stricter underwriting, and we're applying filters to be able to take out as much volatility as we can, such that our models are able to operate. Now, the good thing is, when we came into COVID, we had a $300 million book, okay? And we had a lot of customers in that book. And so we've seen which businesses continued making payments, which businesses did not, which industries fared well, which industries did not. And so we have a lot of learnings from that, at least anticipating what will happen if there's another shutdown, initial wave of coronavirus. We can't prepare for everything. I mean, we can't prepare for, if China nukes the US, we can't prepare for everything that could happen. But we know how COVID looks like, and for that, we have a good idea of how to prepare. And the bottom line is we'll start slow, we'll start carefully. The idea here is to be able to build track record, but at the same time, I do expect things will open up. And I think, humanity and economy is more resilient than people sometimes kind of think, especially when you're in the middle of a crisis. And so I think, 221, I expect things to be maybe not the same as they were in the beginning of 220, but closer to normal.
Thank you. So to the next topic, and this is open for everyone, and I think this crisis presented an opportunity for the fintech industry to prove that it really has an impact on things. And I'm part of this industry. Eyal also, we saw companies like Cabbage, Bluevine, Become, Fundbox all took part in the PPP program and helped distribute funds to a lot of small businesses. And even though we were part of this, and I can speak to myself, being able to help a lot of small businesses get funds and feeling part of the effort, still the whole fintech industry as a whole was taking part of less than 15%. Most of the money was still being delivered by the banks. And my question is, did we succeed as an industry or did we fail? Is 15% a success, or could we do more next time?
So I have a super strong view on that, which is it's 15% by dollar, but I think it's pretty different when you look at it by count. And I think that this is one of those cases where that's not a cop-out, like that's actually the point. Where, with Square, for instance, we did over 76,000 loans and in a month. And so we're definitely top 10 lender by count. We're not close to top 10 lender by dollar. And that's because our average loan size was 90% smaller than the program average loan size. And I'm really proud of that. I think what that means is that we actually got to the fringes. We got to the people who didn't have a shot otherwise. Yeah. To me, again, even the dynamics of incumbent versus startups in this space, I think that's a win. And I think if that continues to happen, whether in a moment of crisis or in a moment of stasis, I think that means that generally speaking, the products will get cheaper and they will get faster, and then consumers ultimately win. What I don't think happens in general with financial services, I'd be super interested to hear what Nikki and Adam think about this. I don't think wipeouts happen in financial services where it's just disruption is Chase went under, we win. It's more the arrival of just fundamentally better products that are faster and cheaper, by the startups forces banks to improve their products in a way that they wouldn't otherwise have to do because they have such a moat. But yeah, no, I think PPP was a huge win for fintech if you look at it.
Yeah, I would agree with this completely. And of course, I have a similar bias to Audrey, although not as personally involved. Two of my portfolio companies, I think I invested in Cabbage in 2012 and Gusto, of course, in 2014. And I'm really, I can't take credit for it, but I'm really proud about how those companies delivered and executed. Really an incredible, stressful situation. And I think that the numbers, I would agree with Audrey about the numbers being more about the number of businesses than dollars, although that might not be the way the government looks at it. I think that's the way the market looks at it. But I will tell you the quality of the experience. If you just search Twitter for small business owners, the stories about people engaging with incumbents around PPP versus engaging with the new entrants, it's night and day. It's not a 10% difference, it's a 10x difference. And as we all know, it's those 10x differences in experience that really, in my view, build the next success stories. And to Audrey's point, I would say, like, people expecting this to be some massive transition, all or nothing, that might be how it works with social software. That might be the way it works with certain applications. In finance, I mean, I used to tell this story quite a bit, but Schwab grew up fighting Merrill Lynch. That was part of their DNA in the 80s, et cetera. And as we know now, Merrill Lynch is not gone. It has been absorbed. A lot of the incumbents ended up converging and merging together. And of course, Merrill is still large today. Schwab, of course, is large today. I'd be surprised if in the next decade we don't see, yes, the incumbents will play their part, but there'll be a whole slew of new brands and names there already are who just continue to grow and take their rightful place in the financial economy.
I have one thing to add here, and I completely agree with both Adam and Audrey here. But I think the presentation right now of the dollars is also not super accurate. And I think you may have asked that question intentionally that way. But keep in mind, there's 5,000 banks in this country, and the number of fintech lenders that were involved were like 10 to 20. I can share, we haven't said this publicly, we've processed over $3 billion in PPP loans to SMBs, okay? That's not a small number. It's most of the regional banks in this country that have been around for tens of years, and it's more than some of the large banks as well. And even more impressive in our eyes is, especially as the program started treating more and more of the smaller businesses, we were still funding around $50 million per day, which is around 5% of the US production across 5,000 banks, okay? So just to give you a sense. So saying that fintechs weren't a big part or a big contributor as part of this program, I think is a little bit missing the point. If you look at Cross River Bank and Celtic Bank, which is the two banks that we worked with, both of them are like top 15 like lenders in the country for PPP. And the reason they were able to do that is because they partnered with fintech companies like us, with Square, with Cabbage, and others. So I think we've actually been able to really play a very important part in this program.
Yeah.
One thing just for the people in this call to understand is that in 2008, when the crisis happened, fintechs had zero participation in anything. Zero. Right, and if you talk about dollars or number of loans, and you're talking a decade later, and it's 15%, give it another decade, it's not going to be 30, it's going to be 45, 50%, and that's where the opportunity lies. It doesn't lie about what has happened to now. It lies where the future is going, and it's clear that Cross River Bank, with no branches, did more than most regional banks. Square, with an app, did more than any other small business provider in the country. Those things don't happen overnight, and they take it's years in the making to be able to capitalize. So this is the first one of many programs. I'm pretty sure I'm going to hear Audrey talk in a year from now how Square Cash is providing more personal checks than the U.S. mail system did in mailing checks to people, which is insane that we do that. And that's going to be a fintech phenomenon. Huh? What's a check? So I think we're just going into this trend where this is going to only get faster, and few companies like the ones on this call are going to succeed at it.
Thank you all. And to another subject, industries, including the lending industry, have pretty much entered into a complete shutdown. Now, I think a question we all ask ourselves as founders of companies who arrived to this situation: was there anything we could have done differently, or is this really like a one-time thing that there's nothing to learn from, and we can't react differently in the next time something similar or not similar this happens?
I think Adam's distinction of a financial versus economic crisis matters a lot. I think no one could have predicted this pandemic, but you absolutely can build your models assuming that there will be long tail events or black swan events, and then make sure that your product suite can respond quickly. And I would say tactically for lenders, the main thing to keep in mind is that duration really matters. I think there have been many times where our average duration is like 9 months. And, in an era of extremely low interest rates and everyone has a lot of cash and everybody wants to take a lot of risk because it looks cool, we got a lot of push to do longer duration products. And frankly, I'm super glad we didn't, because our ability to respond and pull back such that we don't step on the necks of our customers unnecessarily was better because we kept our duration short.
I can add to that as a lender. Well, first, don't be a lender. No, I'm kidding. You can be a lender, but you need to be able to, seriously, if you're going to be a lender, realize there's going to be difficult times, okay? And then you need to be able to live through them. You know what, to some extent, and I certainly don't wish that would happen, but there is a silver lining for lenders that actually go through this and come out from the other side. I've been fundraising pretty much every year for 7 years now, probably making up 6 times. And every single time you go fundraising, the number one question is like, how will you fare in a recession? What will you do in the credit cycle? What will happen in a downturn? Okay. And so I think the ones that are actually going to come through this, there is no more question. Look, I survived something that there was no bigger shock to the system, and we came out of it and we survived and we thrived. And so I think to some extent, it's good for some of the fintech companies to be able to go through this. It adds a lot of credibility to the industry. Not as like a one-time thing, but one that actually can survive through cycles and can be here for the long run. The second thing that I would say, specifically, for lenders and fintech, diversity in products and revenue is important. Okay, like if you look at our industry, PayPal is the biggest SMB lender. Square, I guess, is the second one. I'm assuming their losses, I don't know what the numbers are, they're higher, but it's not going to kill the company, right? They have like multiple sources of revenue. And so I think they're going to come back even for lending sooner than others. And so there's less concern there. A trend that's happened in the industry, more and more companies, us, Wealthfront, and other fintech companies, we are branching out our product suite in an effort to be more impactful and to touch our customers in multiple touch points. Everybody's becoming a bank now. Checking accounts, savings accounts, payments, lending, everybody's doing everything. And we're doing it because we want to serve our customers better, but it also has the benefit of de-risking the business because you have more and more revenue streams. If one of them gets hit, then you're able to survive and the other ones can prosper. And I think that extends outside of fintech. Companies with more diverse revenue streams are more insulated. So that, in my mind, is a lesson learned.
Okay, thank you. Moving to another subject, one of the biggest trends we have seen since the beginning of COVID is a lot of businesses that were traditionally offline had no choice to move their business online. So we see a lot of people, opening shop, joining the e-commerce platforms like Shopify. And another trend together with that is that we just read last week about Amazon and Goldman Sachs announcing that Amazon will now enable Goldman Sachs to lend to their merchants. Do you think that there's an interesting opportunity with online sellers, lending, and all this ecosystem? And maybe
yes.
Yeah.
I think it's a massive, yes, it's a massive category. There's a great underwriting discipline in data. There's a lot of opportunities to build new models, new channels, new ways of providing capital. There's a lot of businesses that are getting built completely online that are just didn't exist in the last 5, 7, 8 years. I mean, we heard of a company that was lending against royalties for YouTube videos. I mean, these are aspects that just didn't exist, which are just smart, and there'll definitely be more of those in the next few years.
Yeah, we've talked a lot about point of sale finance because it's just a law of financial physics that when you add financing, sales go up. I do think, especially for this audience, it's interesting to think about the different kind of cultural and like national norms that surround how you buy things and how maybe single point in time move towards online commerce may or may not have that same dynamic. I'm reminded of when Square entered Japan, and we like internationalized the app, we like translated all the language, but what we miss is that people in Japan, consumers in Japan, are like very grossed out by the idea of signing an iPad with your finger, and so we had to like install a stylus in all the hardware, right? And so there's all these things that are quite distinct and unique to every country's method of purchasing stuff. And I don't know whether that's going to translate online or not, but I do think, for instance, like you see in Latin America, like installment plans are much, much more common than in the US, maybe because, credit cards took hold earlier or whatever. But I'll be interested to see how that kind of translates across borders.
Okay.
Yeah, I mean, I was going to add a minor thing, but I mean, this is close off for the Cabbage folks. This was their original DNA. They originally started, and one of the reasons I was excited about this a decade ago was, coming out of eBay, it was very obvious that this new crop of small businesses, which measured in the millions at the time, and of course now is 10 times, even 100 times bigger, that the existing capital solutions and lending solutions for small businesses just didn't map to them, didn't fit them. It wasn't that the banks weren't interested, it just wasn't a priority. And the data was different, but we're a decade later now, the data is there. People are seeing these different businesses. They're seeing where great businesses are actually capital constrained, which is ironic in an environment where the cost of capital is actually so low. And so I actually think that trend will continue. One of the great things about the fintech revolution is that because it's natively digital, the integration with natively digital businesses can be phenomenal. You can build products and services that are not just grafting credit onto an existing product, like, going to Best Buy and financing an electronic item. That was possible decades ago. You're seeing real native capital functions, in my view, to support new types of businesses, right? So very excited about the Shopifys of the world, very excited about businesses that are capitalizing, whether it's ad spend or others. There will be problems as well, no doubt, but it continues to be a large and growing opportunity as long as e-commerce keeps growing its share of the pie.
Okay, thank you. So I think we'll move to questions from the audience. We have a question from Erez Saf. How do you see the fintech lenders' position if federal grant loan will stop? Would we see something similar to 2008, where the fintech will grow and increase their loan size?
I mean, I can start as a lender. And as I mentioned, we're getting back to lending. I mean, we're going to start cautiously, and we're going to be thoughtful around who we lend to. But we are getting back to it, and I'm assuming that we will get back to it faster than the banks. The approval rates for loans at the banks has dropped from 25% to like 2008 numbers to 11%. And my expectation that we're able to adjust faster, adapt our models faster, and we'll get back to our scale faster than the banks will. And so I certainly think that we are going to be in a position to help fill that void and ideally capture more share in the near term.
Yeah, I think that's 100% right. And I would just double click on us getting back faster. And the reason for that is because our underwriting is present and forward looking as opposed to backward looking. So like our models aren't like, what was your tax return 3 years ago? Our models are, what was your cash flow last week? And so it's another like kind of +1 on cash flow underwriting, real-time data, and the power of that.
So one of the things that we're hearing is that because of the higher risk environment and the uncertainty, we're expecting to see higher interest rates. Now, until today, fintech was always like the friendly ones, the ones who are saving costs, saving time. And I'm wondering, like, is this growing up role of fintech, like you guys mentioned, being faster to get back to lend money, but also probably coming with higher interest rate? How are we as an industry going to like keep the or should we even keep the same like character of like saving costs while we have to also mitigate the risk and ensure our own profits?
I mean, I think
Can I join you, Eden, and ask a question to you guys? Are you actually raising rates? You know, one of the things, at least I can tell you as a bank, is that we're being very closely looked at, and surprisingly enough, competition in the market that we're in is such that we are not really raising rates. And you know, I don't know if you're going to admit it or not, but it's interesting to know.
We don't have, our portfolio in Rivet lends roughly $4 to $5 billion a month of lending in different verticals around the world. Okay. And I will tell you that rates have not gone up, rates have actually gone down. And everywhere in the world, rates are close to zero or nearing zero. When that happens, more capital is willing to find where to get yield. So in the first 30 days of any shock, of course, there's illiquidity and there's no capital. And 60 days, people are fearful. By day 90, you get used to anything. You know, everybody gets used to everything in life. And then you start to realize, okay, I got to go back and make a business and I got to go back and make money. And you have nowhere to get a yield. So I wouldn't be surprised that if we ask Eyal or we ask Audrey as lenders, they will tell you that in the last 2 weeks, maybe their phones have been ringing more than usual about, hey, what kind of structure can we do to raise capital? We have capital. What rate can you get us to lend that capital at? And what can you pay? There is more of that coming. And the more the governments are printing money, the more money is going to be available. So it's just a matter of being efficient and being responsible and transparent. That's what wins.
Amazing.
Right. We're not raising rates. I mean, actually, our blended rate on the book will probably go down because we're limiting more of our high risk segments, and we ultimately price the risk. And so, like, ultimately, probably the blended rate of our portfolio will go down. I will say that, like, the promise of fintech is not necessarily just cheaper pricing. I mean, we've never competed with the banks on rates. We're not looking to compete with the banks on 6% APRs. That's not, you know, possible with our cost of capital, and I don't think that's the situation with Square. What we were trying to do is provide access to capital and do it in a fast and flexible way. You know, it doesn't help that banks, you know, provide capital at 6% rate if they're not approving 80% of small businesses. So the fact that we're providing that access to capital, that's what we were doing. That was the promise of fintech lenders, rather than necessarily coming in at the lowest rate. I do think that there are other products that sort of promise will continue. We are delivering checking accounts and payments, and there we are coming in at significantly more value and lower rates than banks do, and you know, frankly, that nickel and dime on overdrafts and wire fees and a bunch of other things.
I just want to give a counter feedback. We at Become, we are a marketplace working with tens of different alternative lenders, and we actually are seeing, at least for the short term, rates increased. So I hope you guys are right, but right now we're seeing it a bit differently. Hopefully, we will see the trend going down, but for now we're actually seeing higher rates.
And how many basis points do you know on average?
Eyal will tell you it's not the right question, the way to ask it. But overall, the lenders, I think, are feeling that with an environment with higher risk, they need to mitigate that in some way by compensating with a bit higher rate, and it makes sense. So.
Okay.
I think the only thing I would add is that my suspicion is that this is one of those cases where it's very helpful to unpack the average into the various segments, because I believe that people who are higher risk to begin with will get disproportionately punished in terms of higher rates, because it's like kind of meta uncertainty that you add on top of all your models, which only underscores the importance of focusing on access for startups. I think that this is the time, like, there's going to be an ARB opportunity in the sense that any lender, bank or fintech, will disproportionately punish the underserved. And so if you can go serve them, I mean, be wise, obviously don't lose your shirt, but like, if you can go and make it your mission to just serve those people because you don't have the rest of the portfolio that you can rely on, I think there's a chance to build a lasting relationship there, because people remember who was there for them in times of crisis.
And then I think what you're seeing as well is that most of the more prime lenders, us, Funding Circle, Cabbage, others, were really busy with government lending. And what you're seeing is it's more of the subprime MCAs that came back to the market first. And so that's where you're seeing the short-term high rate guys are coming in. I think when PPP is ending at the end of this month, you'll see more of the lower rate prime guys coming back in. And then the rates, I don't expect to be significantly higher than post-COVID.
Okay.
PPP is never over. That's what our team has learned. It just won't stop ever.
I feel like that. It feels like it's been here forever.
They're all 5-year lows now.
I'm done with that
In
acronym.
a few months, it just feels like forever.
Yeah.
2020.
We used to laugh that there's no business model in it, but suddenly a lot of people are actually making good profit out of it. That's the truth. Last question I see from the audience. Any opinion about crypto? Someone writes here, I expected it to be much higher because of COVID.
Yeah, I can jump in on that. That's one of my favorite topics. So I think it's really hard to expect that just from COVID. COVID doesn't trigger crypto to be bigger. What triggers crypto to have more attention is the way governments are reacting to it. Maybe by the debasing of currencies, printing more money, and then suddenly you're going into this spiral where you're hearing any government in any top 15 country in the world telling you that they're printing anywhere between 5% to 30% of their GDP in new money. That is what triggers the interest for something like Bitcoin in particular, which is very different than crypto. It's just one asset within the space. So I would separate Bitcoin from the rest in that perspective. So the more governments print money, the more people will trust a decentralized store of value, and that's a play for Bitcoin. In a world that has deflation, which is what seems to be going into, no asset can appreciate much more than the market. Like, it's just really hard. And Bitcoin has done a good job on holding off on that so far. In terms of crypto in general, this has already sparked a lot of attention into what's called DeFi, the decentralized finance assets, and they're going through their own rally again in the last few weeks, and the volume of decentralized finance is growing. So there's something happening. There's more noise and more activity than any time in the last 3 years. But again, you have to look at this in pictures of decades. When I bought my first Bitcoin in 2011, I could only use it to go buy drugs, kill somebody, or buy arms. And now we're talking about that between Square, Robinhood, Revolut, and Coinbase, just 4 fintech brands, there are more than 30 million holders of crypto in the world, just on those 4. So it just tells you an idea on, if you think about it in 3 months, you're going to overshoot or undershoot. If you think about it in decades, the trend is only going one way.
Yeah, I don't want to sound boring, and I agree with everything Mickey said. Bitwise Invest continues every year to update the true, I think, high quality financial research data for asset managers on what crypto looks like, and particularly Bitcoin. And every year, we're more than a decade into it, it continues to look good as part of a diversified portfolio. It's still too early. I agree with Mickey. You have to think in terms of decades. But it seems like every 3 months, 6 months, 12 months, the number of people who realize that a diversified portfolio that has crypto exposure, that has access to that asset class, the Sharpe ratio is just better. You get a better risk reward for that combination. And so I'm seeing a second and third wave of people enter now into the crypto market that are not religious about the technology. They're not religious about changing the entire financial system. They're just looking at the numbers and the data. And surprisingly, the fact that Bitcoin has actually performed in a reasonable way. I mean, when we look at all these things, nothing is really reasonable, but because it's performed in a reasonable way through the crisis, I think in the end is going to turn out to be a long-term benefit for people's confidence that a portion of their assets should be in digital assets, right? And then you can make an argument about what you think the best digital assets will be. So I can just see the COVID crisis as net positive for the crypto crypto area.
Thank you. Okay, guys, last question. What are some of the opportunities for consumer challenger banks at the moment?
Well, I know. I'll jump in quickly. You know, Acorns, like a lot of the new players in the financial crisis, has actually seen a boom of activity. Right? You know, we keep talking about this as a crisis, but the truth is, on the saving and investing side, it may seem counterintuitive, but during a crisis, actually more people take an active interest in their money. And they might be trading stocks on Robinhood, or they might just be saving more on sites like Acorns. Acorns has now really decided that they are passionate about this subscription model, about this idea of having a one-to-one relationship with the customer, offering them the financial services that they need and scaling up with those needs. And so far, the response has been phenomenal.
Yeah, I would, similar to that, I would say, I think moments like this really emphasize what it means to have a financial safety net as a consumer, and just how many consumers, at least in the US and probably around the world, don't have one. And I think that everything having to do with cash flow and volatility and the real detrimental effect that it can have on someone's personal life is something that pretty much anyone in the consumer finance space should be thinking about.
Let's be clear. I mean, it is easier than ever to start a challenger bank. We get pitched 20 a week. You can plug 4 different vendors today on an API, and a team of 4 can show you a debit card that runs a bank account. I think the complexity of challenger banks right now is profitability and scalability. There's 2 very distinct corners here. There's challenger banks who are starting to become, they start by being a credit provider, by providing credit lending products. And then there's the challenger banks who start by giving you a very transactional account. And those are 2 extremes. And the revenue streams are very different. And the DNA are very different. But to really scale, you got to be able to do both, because subscription alone will build you a nice business, a nice cash flow business, but it will not give you leverage. Credit by itself goes to what Ayal was saying about the cycles of lending and the lack of revenue distribution. So the challenge here is, how do you do both? When do you do both? And how do you scale? Right now, if you're going to tell me that you're going to buy ads on Facebook or Google or Snapchat or TikTok to acquire customers, so is everybody else. So you need to find a niche and a way to get customers' attention and their trust and their money in a way that is differentiated. It's getting harder. That is definitely getting harder.
Maybe just to kind of add to that, I think it's easy to start a bank. Actually, like running and scaling a bank, it's a very different story. There's also operational complexity there, and actually, you know, there's parts of that are not that easy. So again, doing it at low scale, easy to start, but I don't think it's the same. I think the other piece is really building banking for targeted segments. When we see the success in the market for somebody like Chime, it's because they tap into sort of like the demand for the underbanked and really kind of displacing like prepaid cards. That's not sort of like, I don't think the right strategy is to come in and say, look, I'll just build a bank with a debit card and a checking account, and everybody will come to me. I think you need to find a pain point that you're looking to solve for, and you need to build for a certain segment that really you kind of can build and differentiate for. Building something that is just plain vanilla, I don't think have a high likelihood of succeeding right now.
I do want to say that I think it's a good era to prove to you guys can prove that you've passed the crisis, because I think we're well into the crisis and fintechs are around. People are moving their money into the wealth fronts of the world to trade it. So I think if people didn't come back to us, the banks, like by huge numbers, I think this is a well set category. And so even for the banking, I think I agree with Mickey. The model is tough. I can tell you firsthand, banking model is tough. So it's tough for everybody. But I think in terms of confidence of people's confidence, I think we've moved to a new era and it's behind us already.
Okay, guys, I think we're done. Thank you, everyone. Thanks, Icon, for arranging this. It was a great FinTech Summit. And that's it.
Thank you, guys. Thank you for having this. And one little there, my 9-year-old daughter, Mamie, seems to be listening to this call. So hi, Mamie.
Cool. Thanks very much.
Thank
Thank
you.
you. Thank you, Eden. Thank you, Ifat.
Bye bye.
Bye-bye.